All right, guys, we're back. So today's a big day. I'm going to try, like I said, I'm probably only going to do market recaps Tuesday or Monday and Wednesday. But I'm going to try when I have something to actually say or there's a major event coming up, I'm going to try and make sure that I'm there for it if the schedule permits. So today, with the Fed rate decision coming in a few minutes here, about 4 minutes, and then also listening to the Fed speech half an hour after that, it should be very interesting and a fun one, and I'm ready for it. Is Mara doing good? Mara's only up 4.64. I'm liking CleanSpark today, though. Having Trump hanging out with them brought them up 12.32%. So that's pretty sweet. Seeing Tesla up 5% is pretty sweet. PayPal's down 2%. There's that shitty Apple Affirm news that's setting them back. But honestly, everything else is flying. ARKG up almost 5%. SoFi up almost 4%. Hood up 3.5%. Everything is doing well. Flux up 9% today. Palantir's down a little bit, but still, man, like there's a lot of stuff flying today. And the risk on markets are only looking to get riskier if the appropriate things come from the Fed. I'm just taking a look here. I'm trying to see. Meet Kevin's talking. So for a minute here, I'm going to probably jump over to him, and then we're going to talk about my thoughts on other economic data that's happening. We'll kind of talk about that before the Fed speech. But I want to hear what Meet Kevin has to say about this for a second. So let's go ahead and listen.
Deal. Because specifically, we're going to look at what is their projection.
Can you guys hear him okay? Can you hear him? I think his volume is really low. I can try and turn up the gain.
For interest rates at the end of the year. Doombagger thinks it's going to come in at 4.875 based on Wall Street consensus analysis. Volume too low, they say? Hold on, I might be on the wrong audio setting. Oh, I am. Thank you. I can always rely on the folks in the comments to let me know how to. All right. So, look, here's the thing. We're gonna set the stage, okay? We're gonna set this up. Hold on, let's go into the iPad here, all right? We'll go into my little CPI notepad because it's an easy.
I gotta speed things up. I can't listen to Kevin this slow. 1 second.
Pad I got. Kevin's pad.
Want to get to real time.
All right, you ready for this? So the expectation is that the summary of economic projections is going to be revised up from 4.625 to 4.875. Okay, so that's actually really good because I think that's the bare minimum we're going to get. Now, that might look like a 4.9. I wouldn't be surprised if we get something more like 4.7 or 4.6.
And so to be clear, even if we don't have a Fed rate cut, which is super low right now, if I look at this real quick here, let me see what the CME has to say about it. It's not a big number. 1 sec here, let me refresh. Yeah, so June is 0.1%. July is 14.5%. That's actually gotten better. So that's interesting. And then September is over 70% now, 71%. So this is looking good. Especially with what Kevin's talking about. And he's talking about revisions. And I think that'll be probably the primary focus of today. So we'll see what comes out here in the next 1 minute. But he's one of the best sources for it. So here we go.
So this is Kevin right here. Kevin thinks 4.6 to 4.7 this year. And then I think next year, the forecast is 4.125. Kevin next, I'm going to go with 3.9. And Wall Street thinks 4.125. I know this is a little messy. It doesn't matter. I'll explain it when it comes out. Obviously, they're not going to change rates today. We're not going to get a rate hike. We're not going to get a rate cut. We're not going to get any of that boo crap today. We're not worried about that kind of nonsense. What we're worried about is, quite frankly, this summary. What does the Federal Reserve broadly think as consensus is going to be the right signal to send to this market? Remember, this is a messaging tool. The summary of economic projections is designed to give us an idea of where the Federal Reserve's head is. And I think after today's CPI report, you don't want to go like full bull, 10 out of 10 bull here because, it's just the first good report this year. It's not great.
I completely disagree. I don't think inflation is going much higher than it is right now. So I think this is the time to go full bull. And that's why Tom Lee is and a number of other people.
We could use more. Inflation could pick up again, but this is as the Fed will likely say, this is welcomed news. So that's the way I would look at this. Is okay, welcomed news. Good. So what about?
Sure, whatever.
Let's see here. Do we have? No, that's all older. Okay, that's fine. So the last time we got a summary of economic projections, it was all the way back in March. So it's been about 3 months since we've gotten one of these summaries. And a lot's changed in those 3 months. Remember, when they did their March projection, they came in at 4.625 despite January.
Jumping ahead.
Let's look at the details here. We're going to look at the summary of economic projections material as well and figure out, okay, what's actually in the projections for June. And let's see here. Well, if that was roulette, I would have lost that bet. But that's okay, because you can't always win. So here we go. This is the table we care about right here. Wow. Okay, that's not a great number. That's a big revision up. That's actually way more hawkish than I thought they were going to be, so not good. They moved up, but it's in line with expectations. So slower cuts, not great. They kept GDP the same. This is bullshit. They kept the unemployment report numbers the same, and they moved their inflation projections for the end of the year up. That unemployment number is just nonsense. Like, that should be getting revised up. They did revise up the unemployment rate right here and here. What was the range? So wow, nobody thought they were gonna do 3 cuts anymore. 3 cuts are gone. Okay, it is what it is. It's the data. 3 cuts are.
Yeah, I don't think that's too surprising right now.
Are gone. So 3 cutty dudes are gone. What are the, let's
At least with current data.
see, the market's actually not really caring about this that much. You had a red candle, but you're already turning green again, ish.
To be clear, markets are doing nothing. They're very happy. They're still very happy. They're waiting on the Fed right now. So I think
We'll see what.
Oh,
Yeah,
sorry,
the
I
Qs
gotta
are going
fix
up,
that.
Apple's going up
We'll,
again. Okay,
we'll
so,
watch just a little bit longer.
This
and
is
see if there's
surprising to me.
We'll watch a little bit longer and see if there's anything good here, and then we'll move on to other economic data that I was pointing to.
I want to see why. One cut is somewhat bearish. Now, the summary of economic projections gets watched. Be ready for this, okay? I wouldn't go bearish yet. I'm not like dumping my calls and going puts, because J Powell talks this down all the time. J Powell talks in 28 minutes. This guy is like famous for getting up there.
Okay, I don't think there's anything else here that I care about. So we're going to move on from Meet Kevin. And so we've got roughly 28 minutes, 27 minutes until Jay Powell speaks. But now we're going to talk about some other data and my thoughts on the economy for the next 28 minutes. So I just wanted to reiterate something. If you look here, you can see that Canada cut its rates by 25 bips. Europe, the European Union at least, cut its rates by 25 bips. And Powell will be doing that soon. I don't care how many rate cuts the Fed expects right now. It means very little to me. All I know is it's accommodative. I know they're buying back treasuries. I know they're doing things with issuance. They're trying to do everything they can to be accommodative to markets. And China is like them on crack right now, at least to the best of their ability. So this is a really important thing to understand, I think, about the markets right now, is that they're going to be accommodative, and we could see arguably maybe even strength of the dollar in the quarters ahead. I do think that we're going to kind of trough and trade sideways, but that could build up into strength. But I think even in that case, the Fed has to be more accommodative. They've got to produce more currency for the world, and so that I think it's all going to be money making, in my opinion. All right, let's just rock and roll here. You're getting punished. So yeah, in case you don't know this, Emmanuel Macron is basically calling for, quick elections because he basically killed the French Parliament, and it is calling for new elections in a move to try and fight off Le Pen, who is the alt-right, far-right conservative that whatever that is anymore. That was running against him in the last election, basically for a new election where I think she's going to win. And that's pretty crazy. So you've got conservatives that are going to be coming into France. You've got conservatives that are going to take over Trudeau in Canada. You've got Argentina that's turned very conservative. You've got El Salvador, which is very conservative. You've got a shift occurring around the world that I think is becoming very interesting. So I just wanted to point to this economic change that's happening right now, or I should say this political change that's happening right now in France, I think is going to lead to economical changes too in that country and other countries around the world that are embracing a conservative, philosophy and with monetarily, I don't know if they could do that, but at least, they believe in capitalism, and that's good. Bank of America. So Seth Golden, my buddy, it says no Landon, back in vogue. So B of A is expecting a strong acceleration in EPS in the second half of 2024. That's something Tom Lee's been talking about for a while. And that this is going to, be really good for the economy. It's going to be a no landing scenario where maybe we start going back up, and the economy starts to inflate a little bit, and unemployment stays roughly in line where it is right now, while we see growth in the economy. And I do believe that's going to be true. There's a lot of things pointing towards it. Let's see, Seth, the S&P, he says 4-year cycle 2024 could be some turbulence this week, but historic scheduled fund flow ramp suggests material advance into July and through August. So you've got him saying, hey, we've got a summer rally coming. And that seems to be turning into what will be the consensus, I think, here in the near future for people that are still sitting on the sidelines. We got roughly 23 minutes until Fed Powell comes on. We'll be jumping into more stuff related to inflation here in a second too. But I'm just going to keep rocking and rolling here. So this is something that Seth posted. Again, if you don't follow him, do it. Seth CL, he's a great guy. He lives in Jersey, I believe. He's got a Cybertruck, so he's got to be a good person. Anyway, I'm not sure if that's true, but he does seem to be a cool dude. Credit card debt rate of growth is dropping, is what I said in here. Now, the rate of growth is dropping. The growth is still there, but the rate is slowing, and that's a good thing. He actually talks a little bit. We both do. Had some back and forth in regard to this conversation. I don't know if it's in my thread or not, but let me see here. Oh, yeah. So RH said, it's slowing, but still growing double digit, even on high comparisons. How should they get out of the vicious cycle with credit card debt interest rates so crazy high? And I go, yes, but having crazy high rates is a great incentive to reduce credit card debt too, basically saying that people won't want to hold high rates, so they're more likely to consolidate loans and do other things that they can, and like work harder, I don't know, DoorDash. Haven't we been hearing about more people getting part-time jobs? Maybe there's people that aren't so heavily indebted that they're fucked, but have enough debt where they're like, I should pay off my credit cards. These rates are crazy. And so, again, people work towards solutions. Well, some people do. Some people just talk about problems all the time, and those people don't seem to make it very far in life, I don't believe. But others work towards solutions, and the ones that work towards solutions usually end up doing the best. So I did say in here too, now don't get me wrong, 2008's version of all credit card debt lowering is not ideal by any means, but we've also been in a bear to sideways market for several years now, and we're still seeing an increase in global liquidity that I expect to accelerate in the future. And I don't know where Seth's comments might be under his own. I'll go back here. I do want to talk to those. That doesn't mean problem solve. I'm thinking not to. I can't find it. Anyway, it's great comments. Check out the post. The gist of what I'm trying to say here is that, and again, in 2008, my comment about 2008 is we don't want to see credit card debts falling like this because we're heading into a major recession. But also, we've been doing sideways chop for a couple, arguably 1 to 2 years. In some cases in the market, almost 3, right? So with that, the most likely scenario is going up. That is not what happened in 2008. In 2008, we went from a peak in 2007 that was just a fucking blow off top, and then we melted down like a rock the whole time. If you look here, it's not quite the same. So just keep that in mind. Let me go back here. Nope, let me go back one more. Oh, this is jumping around. Oh, I hate this shit. All right, so there is one I want to show. This is Tom Lee just the other day talking about what needed to happen in markets. I won't play this one, but he essentially says that he believes small caps are going to explode, and he thinks that we're going to see 5,500 soon, and by the end of this month even. And I would tend to agree. All right, let me see if there's anything else. I'm going to jump up a few. There's so many of these. I've had so many posts. That's the problem with doing this a few days a week. I build up a huge supply of posts to look at, and some of these I've already done. And then I don't know why, but X's bookmarks literally jump. They will jump on you, and it's a massive pain in the ass. Here we go. All right, right down here. China Central Bank will gradually bring major financial activities, financial markets, financial infrastructure, and non-bank financial institutions under macroprudential management. Now, to translate that into English, what they're going to do is they're going to governmentize everything. So, and they kind of have to do that so that they can hide the debt and try and prevent financial collapse. But it's not going to be a good sign, and it's one that any good Wall Street exec has understands and has seen before in our own history. So this isn't good for China at all. This kind of comment that just was posted here 5 hours ago. All right, so I want to skip that one. This is what I'm talking about. These things just fucking shift like crazy. Okay, so I said we'll continue to see declines in both inflation and core. And this is Heather Long just posting that core and regular CPI are coming down as expected. And again, Tom Lee has a note that we're going to look at here in a second. I might actually just jump to that since this is all over the place. Oh, I do want to talk about this. The mortgage refi index had its best read in 20 months. So not quite 2 years, but exciting because I think this is kind of the initial ramp where people are slowly starting to go, oh, I think rates are going to start getting lowered. And as that starts to happen, as the dialogue increases and or we actually do drop rates, I would expect refis and mortgage activity to start to increase. You will see it. It will happen pretty quickly. It shouldn't be that gradual because it's based upon consumer sentiment. And so I think you're going to see that happen. I think you're going to see that kind of increase. That one I've already talked to. That one we don't need to talk about. Right up here, Fundstrat. The driver of CPI downside, red, was several, but the most important was auto insurance. Literally something Tom Lee has been telegraphing and I've been telegraphing, but I've been getting a lot of that guidance from him, so I've got to be honest where it's coming from. But he was right. Auto insurance was a big part of it. It's coming down. It's not going up anytime soon. So if we actually start lowering rates, oh my bad, if we actually start lowering rates soon, we'll see real estate start to become more liquid, and with that, we should see prices starting to come down and rates coming down, and it should open up liquidity within that market. That should help reduce the inflation that we're seeing in taxes and in rentals. So I think we're seeing kind of a perfect storm here where we're going to start to see a number of elements of inflation start to roll over in a positive way where our economy isn't falling apart. And, unemployment is near 4%. It's not the end of the world by any means. And yet at the same time, we could see things starting to reignite in some of the broad, bigger parts of our economy. A little bit in auto, Tesla, things like Enphase that they do really well. Just a number of areas of the economy, and then real estate again is going to be huge along with auto. All right, I'm going to jump over here real quick. Let me read some comments too. Let's get caught up. Just a thing for the stream. All right, so some people were asking, individual stocks I'm going to skip for now, but the markets are obviously doing fucking great today. Tesla was up 5%. It's pushing up against 100-day moving average so that it hasn't pushed up against in over 6 months. So that's a good sign. We've got Clean Spark up 11%, MicroStrategy up 6%. The shorts are getting fucked today across most areas of the markets, and right now they're just waiting for the Fed to speak in roughly 15 minutes from now. So that's going to get really interesting. I did want to take a look though. Let's look at core inflation year over year. So you can see with the drop we had, pretty significant. We were expecting consensus of 3.5%. Forecast for 3.6, we got 3.4. So again, over the year, you're seeing that strong drop. And again, if we just go back to September of 2022, that was peak inflation in regard to the core, right? And since then, we've dropped really steadily. And if you look at it over a longer time frame, this doesn't look crazy different than some of the peaks we've seen in inflation going back, 50 years. So it doesn't look bad, right? It doesn't look nuts. And that's what we want. And then inflation year over year, just not core. This one, it's a little choppier and harder to see. Let me see. Is this? Yeah, this is a really shitty chart. I almost need to find a different one with this, but I'm probably not going to fuck around with that right now. I don't even know how to do that within this screen. So, but yeah, that's not a great one. So we'll skip it. Let's look at CPI instead. That's probably going to be a better indicator. And we can't go too far on this one, but you can start to see how it's rounding at the top and leveling out, especially if we look at the yearly here. This last read here looks nice and tight, and so we're starting to see it maybe get a little toppy, and that's what we want to see. Let's see what else here. Monthly budget statement. Oh, there's other things I want to check real quick here. I want to see there's other reports that are coming out too. Yeah, here's the projections. So here's the change. So the previous for the 1 year was 3.9. Now it's 4.1. For the 2 year, It was 3.1. It's 3.1 for the current interest rate projection. 4.6 was previous versus 5.1 now. So they're actually currently saying that they expect things to, to be more aggressive right now. And then interest rate projection longer term is 2.6 before to 2.8. So they're raising their interest rate expectations. I don't know. That might not be crazy. That might not be crazy. We've got a lot of weird things going on with China's economy and the world right now in an election year. Weird supply demand imbalances across multiple markets because of tariffs and wars and the threat of war. And there's just a lot of stuff going on. So I don't know. Maybe interest rates won't come down as quickly, but they'll start to come down. Or maybe we see two rate, reductions, 50 bips or something this year. I think that's very possible. All right, let me get back to comments though. I think I actually will start looking through a few of them just to keep us busy here in the next 10 minutes. Let me see here. Somebody asked, Rashab asked about diversifying MicroStrategy funds into SMLR and MetaPlanet, Japanese MicroStrategy basically. I frown upon that. I don't like the idea of hopping into these smaller funds that we don't know what levels of liquidity they'll provide. They might give you like maybe a doubling of what a MicroStrategy could do. But I don't know. I think MicroStrategy is going to be the winner take all in that kind of, Bitcoin custody realm that isn't an ETF. I think it's going to have the right multiplier behind it. And it's just, I think the amount of multiplier you're gaining from making that move versus the risk to reward, it's just not worth it for the risk to, the risks that are there. That's my thought. You said also, I think you added some Mara earlier, but I can't see it in your portfolio allocation on X. Just confirming you still hold Mara. I think I've got it on X. Should. I've got over 200 million, or 200,000 in Mara. Where is it? No, it isn't on there. So I guess I do owe you guys an update on here because I don't even show Mara. So that sucks. So I will fix that. I do have Mara. I've got roughly $200,000 in it right now. Let me see actually what it says. 191,544 as of that second. So there is a decent amount in there for Mara. All right. All right. Let me see what else we got here. Hey, Jesse, I bet you're liking that BTC V-shaped recovery. Let's go. I do like it. I will take it. I'm actually okay. So I think Bitcoin's going to do really good over the short term, no matter what. What worries me is tomorrow the vote with Tesla. From everything I'm reading, it looks really good as far as getting an approval. But I don't know, man. We'll see. And then there's still hurdles that come with this Delaware court and this whole process. It's not over after this vote tomorrow. So I don't know what happens with Tesla. I think it goes up. I think strongly that it does. It doesn't have to, though. But if it does go up, I should just show you what that looks like real quick because it's fucking awesome. All right. So let's look at Tesla. So we're pushing the 100 moving average. That's this yellow line right here. Right down here. We're pushing that for the first time really since we broke out in December of 2023. So again, a little over 6 months ago. That's good. But the measured move for like what we would continue with would get us to the 200 moving average, which would be roughly $209. So you could see a very strong move up into the 200s over a short order if this does get approved. Then you might get some of the negativity of the it's not done yet. Like that could be a thing for Tesla. But that would be a nice move. It wouldn't be anything to frown upon. Let me see what percentage it would be. Where is any of this shit anymore? I'm not in here enough, damn it. All right. So that would be like a 16% move. So if you own the options I own, that's probably like a 50% increase in those options, I believe. So that would be a good move. For me, that would be, $300,000 in potentially a day, if that could happen. So, or week, whatever. Maybe it takes a few days for that to happen. But I think if we get the yes vote, that's the likely path, and that's some good money. I'll take it. All right, let's see what else. And then again, if it does shitty, great. If they vote no for some stupid fucking reason, cool. I don't know if I'll immediately go into the trade. I might wait 3 days, but my goal would be to or longer for Bitcoin to do well and for me to make a bunch of money off of that, since I have like $1.5 million or something dedicated towards Bitcoin and crypto related investments. Tesla's up 5.5% right now, but that would be my goal, is to just make a filthy amount of money off of those, and then start selling some of it, and then buying more Tesla. The 330 calls I think are very safe for June of 2026. So I think that's a very safe play. To say that Tesla could double in the next 2 years, I don't think is insane at all, especially with autonomy kicking into overdrive. If you drove the car I drive, you would just know how game changing this company is. If you've been in full self driving, it's just amazing. Let me see. Do I even have? Nope, I don't have it in here. Yeah, and I'm going to save some of this other stuff. I'm not going to look at that right now. I want to save some of this other stuff for later. We'll talk about Tesla. We'll talk about Bitcoin. We'll talk about a bunch more. We do have about 8 minutes now until the Fed speaks. We're going to hop over here, see how he's doing. Nothing right now, just music. So we're all good on that front. And I'm going to go back over to chat here and see what you guys have questions about. All right, let me go. Keep scrolling down. Where is PayPal? PayPal is doing shitty. So let's see what PayPal's up to. Let's see what the stock looks like. So there was news about what Apple was doing and relationship with the firm. And now there's concerns about that taking away market share from PayPal. I don't think that is real. I don't think that's a real narrative. Like, it will take some. It will take some. I mean, it would be stupid to say that it won't. But it doesn't matter. It's an expanding segment, and the ad revenue and the stuff that PayPal is doing right now is really good. I might add to my 2026 PayPal calls for a 95 strike, depending on how good we're doing and whether or not PayPal is still getting punished. I don't know if I'll do that right away, but we'll see. I think PayPal, I mean, we're at peak volume right here for the life of the asset. So, or I should say at least 5 years. What is this going back to? 2018. So yeah, over 5 years, 6 years of this asset. We're looking at the peak volumes underneath of there. So I think that this is a good bouncing spot. And if it does go down further and Bitcoin's doing great, I would love it if I could buy more Tesla and more PayPal off of Bitcoin strength. I would take that in a heartbeat. Slowly, though. Slowly. No reason to rush. Firefighters are in Bitcoin. Yes, we'll be talking about that a little bit later, at 3 o'clock. But yeah, that's exciting. Come join us at Iron. Nah, I'm good. But hey, man, I hope you guys make tons of money. I know you have. Let's look at Iron real quick. You guys have done really well. Going back, hindsight is 2020. I would not encourage people to chase Iron right now, and I could be wrong about that. You guys can make some arguments to tell me why or who I should be listening to, and I'll gladly listen to them. But we're looking at a $2 billion valuation on this now, and don't get me wrong. Looking back at it on April of 2024, when this thing was $4, if you could have owned it then and then rode it up to what is now in the 13s. That is a sweet ass return. And for everybody that's made that money, I am really happy for you. I hope you make a bunch more. Anytime you can make 200% over a short period of time, I think it's a good thing. But again, I don't think, when I still look at the fundamentals of this company, and you guys tell me why I'm wrong. Tell me why I'm wrong. I'd love to hear it. And if needed, I'll do more research. But when I look at the fundamentals of the company and the news events that have come out recently, I don't see why this doesn't end up taking a break. I mean, we literally are at some peak volumes in this range. And if I run, let me see here. Let me draw a fib or something here. Where is this shit? Jesus. All right, so let me see. What do we have here? 2023, December 2023. This company has not been around long. I'm just going to do a fib retracement. I don't have enough to work with. All right, so yeah, we could actually hit 14s pretty easy. And again, you've gotten a 217% gain in a short period of time. I love that. But let's see, to get another, just looking here, the .618, probably still going to be strong resistance, up roughly 37% from where we're at. And maybe I'm wrong. Maybe revenues are just sick and ridiculous, and this company's going to do really good. But if I did a visual comparison between Iron and CleanSpark right now, I just don't see how the two are comparable. I get that the AI narrative is big. I get that people are probably projecting large amounts of revenue. I get all of that. I just don't think it's real. Or I think it'll turn fairly quickly. But again, everything that doesn't fail is going to do really good over the next year. All of it. So you guys put your money wherever you want, and I hope you make a bunch of money off of it. All right, let me see. What else we got for comments? He'll get it. If Elon doesn't get his money, it's just not a good thing at all. He has definitely earned it. He's definitely earned it, and you're right. He should get it, Damien. But if he doesn't get it, it doesn't even fucking matter. In the end, it'll matter over the short term for the narrative, but he's not leaving. Elon doesn't operate that way. He's not as petty as most people, including, I mean, billionaires are usually really petty, but he's not petty compared to like the majority of humanity, let alone billionaires. So he would do what was right going forward, and they would still sue. They would still, this thing would just go to the Supreme Court, guys. That's all that we're really worried about right now. It's just how long the process takes. We want it to be quick. He will get his. I have no doubt of it. Whether they're reincorporated in Texas eventually and it takes a year or two or whatever it ends up happening, he will get his money. What about Palantir in a portfolio? I love Palantir, John. I love it. I think it's a great company. I own one share right now. I'm looking to double that position. No, I'm kidding. I'm looking to many decimals make that a larger position in the near future. I just don't, when I look at it, Bitcoin and cryptocurrency right now, and then I look at the potential for Tesla or a rebound from PayPal and some of these others, I think those returns are much greater than the PE ratio that we're seeing right now for Palantir. And Palantir is a great company, and I don't want to be like negative about it. And I do think that this is a great hedge against war too, which we could see in the future. But the problem I have is just the 67 forward PE and the 188 PE right now. But I do think that this is a great company, and as I make a bunch of money off these other investments, my thesis has not changed. I will buy a lot more Palantir. I would love a year from now to own at least $1 million in Palantir, if that gives you any perspective on my dedication towards the company. And I did make $600,000 off of Palantir. I think I need to improve my dB here. I don't like the volume. 1 second here. I'm gonna share mic. Oh, it says it's all right. Maybe I just need to get my face closer to it. But yeah, so I do plan on owning lots of Palantir, and I made $600,000 off of Palantir last year in 2023. So I did pretty good off of it, and I love the company, and I think people should own it. They'd be dumb not to. I think there's better asymmetric bets right now, though, like next 3 months, 6 months, 9 months, a year. Phil, Tesla has so many catalysts coming up. It's a layup long term. It fucking is. Yes. Mark LeBlanc, like CleanSpark, under $3. Yeah, CleanSpark in the ones was awesome, and getting options of CleanSpark in the ones was awesome. I sold them too early because I got burned last cycle when I didn't do that. So I was a little conservative this time around. I wish I would have been more aggressive at that time. MB, but I did make 700% that year. So if that's fucking up, I'm hoping for a lot of fuck up this year. MB, talking of PayPal and payment methods, have a look at four. Yeah, I've looked at them. Let me know what you find appealing versus PayPal. Mark LeBlanc, I sold my pet moose to YOLO into Iron at $4. I really hope that story is true. All right, let's look here. We need to make sure that we're not missing the Fed. Fed's not doing anything. Okay, we're good. I hope that story's true, Mark. I do. But I'm either way. Oh, hey, it's time. Let's listen. The bastards. All right, you're stuck with me for a minute. They've still got music playing. I'm going to go ahead and mute this because I don't want to get demonetized. And then I'm going to jump ahead just a little bit. All right, the second we start, I'm going to turn on probably subtitles here. And that way, the second they start speaking, oh, it says it should be doing it. Okay, cool. So we'll wait for them to say something and then I'll jump in. But yeah, let's keep going. Let me see. Oh, the man, the myth, the legend. Let's see.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range
If you guys could hit the likes, it would be greatly appreciated. Thank you.
for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and
I just want to say there's some very interesting stuff that's being said right now, real quickly. So I think the setting expectations for inflation being higher for much longer, but gradual, like not dangerous, but it's reducing over years, is just a way for them to get people okay with the fact that inflation is never going back down to 2%. I 100% agree with you, Chris, and everybody that's talking about that. There's other great stuff here too, but let's listen.
employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026.
They're literally talking about over the longer run, well past 2026, inflation still being in the 3% zone. So again, it's not getting to 2% ever again.
But these projections are not a committee plan or any.
And the reason, so the Fed funds rate might end up dropping lower than this because it has to. But yeah, the reason is we need to print all that we can, and we have to keep things going, or we need AI and we need fiscal dominant. We need to do things right. But yeah, anyway, let me get back to it.
Any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
That was really quick. This is great.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out, and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming a good but.
He said they're being conservative on their estimates for this. This is good, so it might come in better. I love hearing that.
not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and then hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher, 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Did you hear that? It's not about 2% anymore. 2.6, 2.7. Perfectly okay. We're getting closer to 3%.
Nick Tamaros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary economic projections and the dot plot, their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible. But I look at so I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it that is on the committee a really strong commitment to a particular rate path. It's actually just their forecast and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier. We want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because really it's going to be not just the inflation readings. It's going to be the totality of the data. What's happening in the labor market.
I think what we're going to end up looking for and seeing is going to be a flattening of the data. I don't know that it's going to get dramatically better from here for inflation. I don't know that it's going to get dramatically worse. It might just wobble for a while, but I think that's going to be okay.
What's happening with the balance of risks?
I think that they might still ease based upon everything they're trying to do between the Fed, the Treasury, everything that's going on, the election year, so much around the world. But at the same time, though, I think we're in that easing realm right now, and I think we could see this wobbling of inflation up and down. I think that's the more likely base case nowadays.
What's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident, have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively,
I also want to add, too, that people want that, right? Like they want to know that the ripple isn't going to be that great and that we're just starting to see some stability. Because if we start to flatline and we don't get this rolling over effect where we go way too low, and then we have to whipsaw back up. If we get some flatlining, then people are going to start to say, oh, hey, after, 6 months, whatever, this looks really fucking great. We're going to start going higher. We're not getting this crazy, like it looks like a bottoming pattern, right? Like that's what they're going to be looking for. And if we see that with inflation, where it's still just chopping and it's not going anywhere, and it's not dropping too hard either at the same time, that sets the stage for higher interest rates being the new norm and being okay as long as it's stable.
Do we see really unexpected signs of weakness in the labor market that would call for a response?
And the government has to have it that way.
which is another thing that could happen. But again, we don't see that, and we see today's report as progress and as building confidence. But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you?
The market's actually doing really good.
Got the inflation numbers today.
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. But and I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today to the extent you can reflect it in one day. I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Janelle.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago. And we've seen it gradually move back into much better balance between supply.
I've got to throw in one thing here, okay? I want to point out the fact that I think it's fucking brilliant that the Biden administration and the Fed have had illegal immigration pick up and have over 8 million people that have crossed the border since Biden's presidency. Because if you think about it, it did a great job bringing down wage inflation as people that are used to making nothing would come across and work for very little. And so by doing that, they've helped take wage pressure away and reduce the strength of the unions that they say they support. It's actually brilliant. It takes the stress away from the whole, we want a minimum wage, yada, yada, when somebody will just work illegally and do the same job.
Supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So we put all that together. What you have is still low unemployment, still 4% unemployment, historically low, but it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully. And that's what we see. We see gradual cooling, gradual movement.
It's also beneficial for companies, too, that can pay illegal immigrants a fraction of the amount they would pay a normal person that is a U.S. citizen. So for anybody that's jumping into the job market, again, I just think that this is a brilliant move. It's counter to everything that Democrats represent, but I think it's actually probably what they've been doing.
Moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what was still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. You know, there are fewer rate cuts in the median.
Keep in mind that as they say this, though, they did slow the pace of the sell-off of their balance sheet, and the Treasury has started buying back bonds. So they are actually loosening right now, even though they're acting like they're going to wait to loosen. They're already taking steps that help with that.
This year, but there's one more next year. So you really, if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data.
And remember, they're plotting out what they said with the core PCE inflation, that the Fed's trying to be conservative about their expectations for inflation. He just said that earlier in this speech. So that is very important too. The fact that they're being conservative means that we have the potential for outperformance, and that is a great condition for markets to continue to go higher.
Flow brings and how that affects the outlook and the balance of risks.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
Yes.
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star is a very important concept in economics and in what we do, but honestly it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute.
Yes, that's exactly what's going to happen. Thank you for saying it out loud.
And discussion to have now, but ultimately we think that things like the neutral rate are driven by longer run, slow moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been the policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion that the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start.
That's a pretty good question.
with that, clearly a lot of what, some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand. And that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had, above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. Look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point?
To be proactive, for the love of fucking God. Richard, my friend, how you doing, brother? Thank you for joining, man.
For a rate cut.
Well, we think policy is restrictive, and we think ultimately.
Again, we want to be fucking early with lowering rates. Every time the government has been late lowering rates, it's been pure reactionary. The house is burning down. That's the last fucking thing we want to do. We want to start it proactively so that the market can maintain. That's why. That's exactly why.
That if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point. Not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. That's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So we're getting good results here.
This is great. He actually said basically that they want to be proactive so that they can continue to support the market. So he said the same thing I did, which is perfect. This is the kind of Fed I want to see.
Is there any kind of concern for the housing industry or financial stability banks in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately,
yeah, they're having a significant effect by creating more inflation. Awesome.
Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions.
That part's fair. But at the same time, when the existing home market isn't selling any houses, and that made up like 80% of previous sales, that's a big deal.
That we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts, McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in in import prices on goods, which is kind of hard to understand. And, we've taken some signal from that, but, and of course, housing services, you're continuing to see high readings there.
Yeah, housing's fucking expensive because rates are too high. Fix it. Jesus.
To some extent, that's catch-up inflation from earlier pressures. But, overall, you're right. Inflationary pressures have come down.
Again, commercial companies are building fucking apartment complexes that are costing them a lot more money. Taxes are going up regionally across the entire United States of America. At least everybody that's done really well and seen a 40% increase or more in their housing prices since the pandemic. So it's going to be a lot more fucking expensive in housing until rates start to come down to open up the market. We need to see prices come down. We need to see rates coming down so that the market can open up and people can start buying again.
As I
This part is not fucking rocket science.
mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that.
Then we need to have some more immigrants coming over, maybe some legal ones too that can fill some of the higher end jobs.
We haven't thought of wages as being the principal, cause.
Or robots like Optimus or autonomy, which takes away jobs too. We will see more of this. This problem will be fixed.
Of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters. And I do continue to think that when
I got to argue against this just real quick and I'll let him finish his thought. I'm sorry for interrupting Jerome Powell. But it's important. It's a signal. It's a signal that we're in a changing economy that is no longer going to be raising rates. Just like when we paused, that was a signal too. Lowering rates signals that we're trying to be accommodative, and it signals to people that in the future, most likely, they're going to get lower interest rates. So if they want to buy that big $1 million home that they always wanted, that just had a price drop and it's looking good, they can lock it in now at a price that's, going to be better. And then at the same time, since we do still have a housing shortage, then at the same time, they can look at lower rates in the future. And so you open up the markets, and that's what we want.
And when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that, we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction, but one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
I got to say one thing real quickly, and then I'll get back to it. We have the exact opposite problem as China right now, and it's such a blessing for our fucking country. China has 60 million excess homes, roughly, which is a huge number, billions of people, or I shouldn't say that, enough to be able to accommodate everybody in their country that needs a home right now. So they don't have any building that they can do that helps their economy anymore. We have tons of building to do. The government, Trump, whoever's in office this next term, needs to focus on incentivizing housing to be built up around the country in some way. However they can do that where it's effective and doesn't cost the American taxpayer a lot of money. Because if they do this, then we could have legal and illegal immigration and be able to get it to where we're keeping wage inflation down, and at the same time we're lowering housing prices. We can't do it too crazy, but again, I think we need to fire up the economy. We need to fire up real estate, especially, and other parts of it. And I think we're looking to do that while at the same time China is just going to get crushed. They don't have this lever to pull.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
It's probably because you're poor and you don't have assets and you're getting fucked.
Do
you think he'll say that?
I don't think anyone knows as a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy.
Oh, okay. He's not going to say that.
Economy. That's not our job. Where people experience what they experience. All I can tell you is what the data show, which is we've got an economy that's...
We're just talking about feelings. And the economy's fine, guys. It's not that you're fucked because you don't own assets that appreciate in value, and at the same time we produce more than 40% of the money that ever existed in the country's history since the pandemic, and then now we're going to keep printing a bunch fucking more money because we have to. The world has to. It's not because of that. It's not that you're getting fucked because you work an hourly job and you don't own enough assets. That's not why.
It's growing at
It's just feelings.
Solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had, a long stretch of time with unemployment at or below 4%. Very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated...
And he should throw up a sign that says buy Bitcoin because that's your only fucking hope.
One interest rate cut sometime this year. And I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect?
Remember, it's expensive for the government too, which is why they have to cut rates. Inflation will be at 3-4% every year for the foreseeable future if we're lucky. And the Fed might drop rates down to 0 again in the years ahead because it's expensive for them too, and they can't have the primary line item of the federal budget be interest on debt. So they got to make it cheaper.
Some relief.
Well, I don't have a precise date for you, but what we said is that we want to make sure...
We need to make sure that China's fucked enough. That's what Jerome's trying to say right here. We need to make sure that China is utterly fucked financially and that they're at a deep level of deflation. And at the same time, we've helped them do this over a slow enough period of time that as their economy is destroyed, other Southeast Asian and Central American and South, African countries that are friendly towards the West benefit from this failure. That's what he's trying to say. We can't, because then if they're deflating, if China's fucked, if Russia's fucked, and they're deflating really badly, and these BRICS nations are doing poorly, and we're doing really well, then we can print all the fucking money we want. That's what Jerome really wants to say.
That we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time.
Then be kind to people like Elon Musk and Bitcoin.
And our goal is to get back to that place. And we've made good progress. And we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
Which is fucking sticky because we let taxes get so fucking high from inflating the property prices of these places by printing so much fucking money. And so it's sticky because of the taxes. It's sticky because of the high interest rates that commercial companies are having to spend in order to produce houses. Let's make it fucking cheaper for them. You want to know how we could do that? Lower rates. Lower rates. Make it cheaper for them to be able to build. That's how you get more fucking housing. And that's how you make it to where it's cheaper in shelter for renters too. Because if the person who built your fucking property didn't make any fucking money because rates were too high, and they're certainly going to make up for it on the backs of the people that they fucking rent and lease to.
Encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth, solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after several reports that were not so encouraging. You ask about your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there were renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent.
40% of Americans own their home.
And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents. It has to get worked off, and that may take several years. Nonetheless.
Yeah, it certainly fucking will if you have rates high to where these companies have to charge more for the people that are renting to be able to sustain the debts. Like, it's fucking stupid. Just lower rates and fix this entire problem.
As long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It's just going to happen more slowly than we thought. We also do sort of this thing where we impute rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break?
And yet, as I showed you in today's video, the rate of growth in credit card balances is reducing.
The consumer in terms of spending?
So, we monitor all the things you mentioned and more. We're seeing.
Now, that's as of like the entire field, right? To be clear, subprime probably looks like shit.
Is basically spending was going up faster than disposable income during big parts of last year rather. And so what that you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But
it's all subprime. It's poor people. The Fed doesn't care about that.
Households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people. And the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation very directly, very painfully. And once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guido with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecast. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I can think of things many things would make it on that list, but I don't think I'll butter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality of the data. The labor market data, the growth data, in terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Which he's plotted out over the course of years. So it's a very slow path and goal that needs to be met.
Okay. Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that markets should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not and for our economy.
The dollar has actually been flat for a year and a half.
What we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE. We're at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral to try to preserve the soft landing rather than risking waiting too long.
I like her.
In the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there. And we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
This is good. He's saying that the Fed's being conservative on their PCE inflation expectations, and at the same time, they're going to be proactive. This is the messaging the markets wanted. Everything looks good. Clean Spark's up like 13% right now. Tesla's up 5.5%. It's a good day, guys.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one thing, one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
All right, the housing thing at the end kind of weirded me out, but I got to say, I like the fact, again, they're being conservative about inflation and their expectations for it, and they're notating that to the markets. I like the fact that he's saying that he's going to be proactive and that they're going to lower rates before it's needed. We know that, again, they've slowed the roll of their balance sheet runoff, so they're selling equities at a lower amount. The Fed isn't dishing them out at the rate they were before that was drawing down markets in 2022 and even a part of 2023. And then at the same time, you got the Treasury buying back. So it's all accommodative to the markets. It's all good stuff. China is falling apart. I do have to do a special about that. I said I'm going to start making more of these videos so that I to cover things that I need to be talking about or that I think I should be sharing. That's one that's long overdue. So I'm going to try and do something. I don't know if it'll be this week. Maybe it's next week, but I'm going to try and do something about that. C-List. So housing price dips 10%. It would not concern him. BS. The housing price needs to dip 10% because if it does that, we're going to see volumes start taking off like crazy. As long as people are employed and have money, they're going to buy houses if the prices start to dip and they find that home they're looking for. As long as inflation is stable, right? Like the data that we see with, CPI and PCE, as long as everything's looking stable, that's what they care about. And then they can just slowly lower rates or at whatever pace they need. But the slower they do it, the better it actually probably is going to turn out. You can see from the 90s and 80s how true that statement rings. For the parts where we did slowly lower rates after raising them, we had markets that actually did pretty good. So anyway, this is fun. I don't think I have a lot more to elaborate on outside of that. Markets are doing good. I think they're going to digest this for a while. I think they'll continue to do good. Let's see what we have for economic data coming next. Tomorrow we have PPI, so we're going to quickly shift narratives here to PPI and jobs-related data tomorrow. And then we have export-import prices. That should be fascinating, looking at China and how well they're doing with the United States. So I'm very interested to see how that works. So it should be a fun rest of the week. We'll see what PPI, if PPI leads to some of the same stuff that we're looking at here, then we could have a really great day again tomorrow as well. But the narrative's going to shift a little bit. We'll probably jump out of Fed now, and we're going to start jumping into jobs and PPI data. So we'll see what the market does with that. But I will talk to you guys in about 35 minutes when we do the market recap. And we'll be focused, since we covered so much with economic data and the Fed, we'll be focused on Bitcoin, Tesla, Palantir, maybe some PayPal, some other stock-related things, and kind of that, I think, will be the focus. So I'd love to see you guys there. Anyway, take it easy. I will talk to you later. I'm going to go ahead and hang up now. Peace, guys. Bye.